G'day everyone, it's Heath from You&Me Personalised Property Services here today for another catch up with Matt from Capita Finance. G'day Matt.
Hey Heath, how are we doing?
Fantastic mate. I don't know about the rest of Australia, but obviously hot off the press, we're talking about interest rates and we've just, the cash rate's just gone up another 0.25%. And we're here to talk in real terms what that means for lending and what that also means in your back pocket as well. So Matt, if you want to explain the RBA cash rate now and what that means in banking terms.
Yeah, so as everybody knows, cash rate went up 0.25%. When we're looking at real terms, what does that mean for the borrowing capacity for everyday Australians? And the good rule of thumb is for every 0.5% it increases, it's about 5% reduction in your borrowing capacity. So if you could borrow $500,000 last week, this week you can borrow $475,000.
Okay.
Now that's going to have a big impact on basically buyer sentiment. So people obviously getting nervous, which they shouldn't necessarily be getting. And I think there's been a massive, there's a single source of truth, and that's the RBA.
Yep. It's a bit of a reaction chain going on.
That's right. So the RBA know what they're doing. They're going to get us in line with interest rates and what we're going to, with the CPI rather, with inflation. So the media have liked to come out and talk about things in very scary terms. So will you be able to afford your repayments? Will you be able to buy groceries and keep your home? That kind of thing.
Yeah,
nice shiny headlines.
Mate, that does not sound like the media at all. So.
That's it. So when you look at real terms, what impact it's going to have? Well, the banks have a buffer of 3%. So pretty much everybody over the last 2 years have been assessed at 5%.
Okay.
So in real dollar terms, theoretically, we should be okay. People should be able to still afford their loans, and there should be room there to move.
Okay. Yep, perfect. And I guess when we talk variable versus fixed, again, people are confused, wondering what they should be doing. Maybe we should have fixed it at low rates, but the damage is done now. The banks have moved on whatever they're moving on.
Yeah.
But in real terms now, what are we getting a variable at, and what are you seeing fixed at?
Yeah, so fixed rates are a really good indicator of where people sort of see the market. So when we talk about whether the market's got it wrong, in this case, we think there's been an overreaction.
Okay.
So when you look at fixed rates come from the swap rate market. Now the swap rate market is an actual market. It's a traded market by the banks, and that's where they get their rates from, because that allows them to effectively lock it in so that they're not out of pocket when rates plummet or increase.
Okay.
Right?
So the banks are always secure, whichever way you look at it.
Yeah, exactly.
Okay.
Now what we've found is the RBA and the customer sentiment generally was that the RBA won't be changing rates till 2024. So now that hasn't happened and rates have increased quite dramatically, because we've had inflation at 5%, which the previous quarter was at 2%. So that massive jump has effectively been passed on by the RBA to make sure that we get it in line and in control, because that's their job.
Okay. And so what are you seeing variable right now?
Yeah.
Across the board, we're not talking specifics, but across the board, what are you seeing variable, and where are you seeing fixed as a general?
Yeah, so variable rates can still be sitting around 2%.
Okay.
They will be passing on, that's for those banks that haven't yet passed on the 0.25% increase. But then we're going to be looking at 2.3, 2.4. So you could conservatively say 2.5% for a variable rate at the moment.
Okay.
And then fixed rates, we're looking in the 4s.
Okay. So we're talking about, give or take, 1.5, 1.7% difference there. So in your opinion, should people be looking to fix at 4%, or should they still ride out the variable until it hits the 4? Where are we at with that?
Yeah, so determining whether you should fix or have it as a standard variable rate is a conversation that we have every day with clients. It's really important, because in situations like this, where you have an overcorrection, the market believes that 2-year fixed rate should be at 4.15% right now. in order to determine whether that's something you should do, being to fix your rate at 2 years or to go 100% variable, you need to look at how the value of a fixed rate comes about. The value comes from when you have a variable rate that's less than your fixed rate, which is at the moment significantly.
Yep.
You will be paying a premium by fixing right up until you hit 4.15%, or the market hits 4.1.
Yeah, so in essence that, you sit at 2.5, you've got a 1.5% buffer to the 4, but in that meantime, however long it takes to get from 2.5 to 4, you're paying 4% as a fix.
Exactly.
So you're actually paying an excess amount right now just to, I guess, secure yourself in.
Exactly, yeah,
Okay.
That's it. So you're just burning money effectively
cool.
until you hit the 4% mark.
Yep.
Then as soon as rates go over 4%, that's when you see value in fixing your rate.
Okay. So what would be the advantage to fixing a rate right now? So we talk investors, people knowing what they're going to pay every single month for the next 2 years.
Yeah.
Are they the advantages to that?
Absolutely. So you call it the certainty premium, right? So I know what I'm going to be paying. I know, especially for investors, because a lot of the time the interest, because it's tax deductible for them, doesn't have as big an impact as your owner occupiers.
Yep. And they build that with rental yield and the like. So
exactly, yeah. So you can even it out,
Yep.
as well as other costs comes into it, tax deductions and all the rest of it that comes with an investment. So for them specifically, fixing might be a good option. For the everyday Australian, or for those investing into properties where they don't necessarily need that certainty, and interest is more important because you want to maximize yields as an investment property. It's all about making money, right?
Absolutely.
So in doing that, you may look at, you'd have to look at, will a standard variable rate make me more money over the next 2 year period than if I fix?
Yep.
Will standard variable rates go past 4.15% within a 1 year period? I don't see that happening.
Okay. All right, cool. So I guess what you're saying with because it's so far out from each other, variable is probably the not safer, but more sensible option in regards to repayments.
Yeah.
But at what point would you go, let's say me, for an example, I'm fixed for the next, I think, 1.5 years. I'm going to be in that transition period where I'm, is it going to be a closer variable versus fixed? And at what point do I go, it's safer or it's more convenient for me to go fixed and I'll take that little bit of a premium hit?
Well,
is it 0.5%? Is it?
It's hard to say because it depends on the market.
Okay.
So what we're going to look at now is, how is the economy doing? Well, the economy is strong. Unemployment rates the unemployment figures will be coming out shortly. We're at a 50-year low for unemployment since 1974.
Yep.
So we're in a really strong economy. If unemployment's low, it's reasonable to expect that wages will grow, and that's going to be a massively important factor for the RBA in determining how it impacts their cash rate. So if the economy is managing to stay within their range, then they will slow down on their rate increases. So we need to just monitor it carefully. If we're in a position where standard variable rates are still in record low territory, then we should be taking advantage of that. If not entirely, then at least a portion of it.
Half and half. Yeah.
And that's where you can split your loans. So what we're finding is a lot of people say, okay, well, look, I want somewhat of a certainty because I am concerned about interest rates rising. Will they exceed 4% over the next 2 year period? I don't think so. I think it's going to damage our economy way too much because it's just going to impact house prices. House prices, people are tipping that if you increase interest rates by 1%, you'll have a 20% impact on house prices. That's ludicrous. Will it be that extreme? Probably not, but it will have an impact, and the RBA knows. Because
essentially, real time, you're talking if we go up 2%, we've lost 40% of our housing. Equity.
Absolutely.
Which is crazy to think.
So on a $1 million house, it drops down 200 grand.
Yep.
How can you take $200,000 out of an Australian economy, family's economy? So it's too much of an equity drain out of the economy as a whole.
Cool. So we talk about when you're saying the borrowing capacity is going to be less. Is there any hints and tips out there for people wanting to increase their borrowing capacity? Get rid of the credit cards, get rid of debts.
Absolutely.
What's your hints and tips there?
So big part of what I do within the firm is having, or in the brokerage, is to have a holistic look at finances. So it's important to whoever you're dealing with to have an approach where it's not just the mortgage, not just the residential or investment, owner-occupied investment products. It's your credit cards, it's your car loans, your personal loans. If you're doing renovations, where are you sitting? Nobody should be paying over 10% on any personal loans or any month to month on a credit card. If you're paying minimum repayments on a credit card, you need to be refinancing out into a personal loan at 6%. You know, personal and asset finance is still very low. Asset finance is moving, but it's still significantly lower than what it was a few years ago. So they're the kinds of tips to be able to reduce expenses. So you have two options: reduce expenses, increase income. If you can't increase income, you need to reduce your expenses, and that's a good vehicle to do that.
Well, I need to start upping my my salary, I think. So there you have it, guys and girls at home. If you'd like any more information, Matt, how can they get in contact with you?
Yeah, so they can contact me on 0400 974 336.
Yep, Matt from Capita Finance. Thanks again. If you've got any questions about housing, Heath at You&Me Personalised Property Services. Until next time, we'll speak to you later.